Last night, while most people were doom scrolling, the real panic wasn't on social media. It was in a spreadsheet. Quietly, almost nobody noticed. Central banks reported record gold buying again. Unreported demand, the stuff that doesn't show up in neat headlines, hit levels we haven't seen in decades. And buried under the gold numbers was a second story. They're quietly moving into silver too. The metal retail investors think is a meme, and central banks are starting to treat as insurance. Here's the part that should make you sit up. For the first time since the 1,990 seconds, global central banks now hold more gold than US treasuries in their reserves. Let that sink in. The institutions that create fiat currency are dumping the most famous fiat asset, US government IOUs, and loading up on the one thing they can't print. They're not posting TikToks about it. They're not making YouTube thumbnails. They're just buying. In size, overnight. This video is called Central Banks Just Panicked. Record gold, silver buying reported overnight. By the end, you'll understand what central banks just told you without saying a word. How record gold buying and emerging silver moves fit the same four-stage pattern we've been talking about. Why their panic buying is your last quiet chance to act before the crowd. How to respond like a strategist, not a FOMO trader. This is not personal financial advice. This is a translation exercise. Because when central banks panic, they don't scream. They allocate. Central banks are supposed to be the adults in the room. Think about how central banks talk to you. Inflation is transitory. We have the tools. The system is sound. Calm words, reassuring tone, always in control. Now compare that to what they're actually doing. Since 2022, central banks have bought over 1,000 tons of gold per year, the highest sustained pace since records began in 1950. In 2024, net purchases hit a fresh record, around 1,180 tons, more than double their average annual buying in the previous decade. Their share of total global gold demand has climbed toward a quarter of the entire market, up from roughly 10–12% just a few years ago. And it's not just the usual suspects. Emerging markets are leading the charge. China, Poland, Singapore, India, Turkey, and others. Even longtime US allies are quietly diversifying away from Western currencies and government debt. At the same time, something else is happening. The EU is openly discussing using frozen Russian reserves to fund Ukraine without technically confiscating them. A polite way of saying your reserves may be weaponized if you displease us. Sanctions froze $300 billion of Russia's assets in 2022, proving to every central banker on earth that risk-free reserves are only risk-free until politics changes. So what are they doing? They're moving into the one reserve asset that has no counterparty, can't be frozen by a sanction, doesn't depend on a Western legal system to be real. Gold. And increasingly, in smaller ways, silver. They don't call that panic. They call it reserve diversification. Same thing, different branding. The four-stage pattern. From the central bank's point of view, we've talked before about the four-stage pattern for monetary metals from a market perspective. Today, I want to flip the camera. This time, you're sitting in a central banker's chair. Stage 1, trust. In stage 1, the story is simple. The dollar is neutral. US treasuries are risk-free. Our reserves are safe. You hold dollars, euros, government bonds, maybe some gold, out of habit. The system looks stable. Nobody questions the plumbing. Stage 2, discomfort. Stage 2 begins when reality creeps in. Debt loads explode. Major economies weaponize their currencies and payment networks. You watch reserves get frozen, legally, because a block of countries change the rules. You don't panic yet. You adjust. You trim some treasuries. You add a bit more gold as insurance. You talk in public about diversification and prudence, not fear. On the surface, everything looks the same. Underneath, the chessboard is shifting. Stage 3, quiet panic, where we are now. Stage 3 is where we live today. This is the phase where gold stops being just tradition and becomes protection. You realize that in a sanctions world, your reserves in New York or Brussels can be turned off like a light switch. You look at your own currency and wonder, if we get caught in the crossfire, what do we hold that no one can cancel? So you act. You buy gold, quarter after quarter, regardless of price. You repatriate bars from foreign vaults back home. You quietly explore adding more silver to your reserve mix. Because if gold is being hoarded and silver drives your solar, electronics, and defense industries, leaving it entirely to the market suddenly feels reckless. Do you announce this in a press conference? Of course not. You report numbers months late. You underreport some purchases. Half the buying shows up as unallocated or unidentified, forcing analysts to guess. From the outside, it looks like strong gold demand. From the inside, it feels like we can't be the last ones holding only paper. That's central bank panic. Polite, orderly, data-driven, still panic. Stage 4, open admission. Stage 4 is when it spills from spreadsheets into headlines. A major central bank announces a new gold-linked product or settlement system. A bloc of countries formalizes a trade currency backed in part by gold. A sudden event, default, conflict, sanctions escalation forces everyone to show their hands. By the time that happens, the buying is over. The window doesn't close when your favorite YouTuber says, "last chance." It closes when central banks stop buying because they already have enough. We're not there yet. We're in stage 3. Quiet, record-level accumulation under the cover of normalcy. Why silver is sneaking into a gold story. On paper, this is a gold story. World Gold Council, IMF tables, reserve data, but markets aren't neat. When central banks buy record tons of gold 3 years in a row, and gold becomes the second most important reserve asset after the dollar, overtaking the euro, something else happens. Silver starts moving in sympathy and then exaggeration. We're already seeing it. Silver's percentage gains have outpaced gold's over 1-3-year windows. It's chewing through resistance levels in the $50 seconds and eyeing the $60 area, even as gold sometimes pauses. Why? Because silver sits at the intersection of monetary fear and industrial necessity. When central banks panic, they grab gold. When investors watch that and panic, they grab gold and silver. When the energy transition, electronics, and defense sectors panic, they grab silver first. Unlike gold, you can't take silver out of the industrial system without breaking things. Solar panels, EV electronics, grid hardware, medical devices, all sip silver all the time. So central bank panic buying in gold doesn't just bid up gold, it tightens the entire precious metals complex. In silver, the smaller, tighter market moves more violently. They panic in gold. You feel it in silver. What central banks just told you without saying a word. If you strip away the jargon, the message behind last night's record buying report is brutally simple. We do not trust the future value of paper claims as much as we did 5 years ago. They will never phrase it like that. They'll say, "We are diversifying reserve composition. We're responding to geopolitical uncertainty. Gold plays an important role as a long-term store of value." Translation. We've seen enough to know that currencies can be debased mori. Reserves can be frozen. Laws can change better. And our only defense is to own something nobody else can print, block, or cancel. That's panic. Calm, quiet, spreadsheet panic. And here's the uncomfortable question. If the people who create money are running for the exits, why are you still sitting in the theater pretending the fire alarm is part of the movie? How a normal person responds to central bank panic without losing their mind. You are not a central bank. You don't need 1,000 tons of gold. You also don't have their problem. You don't need to manage a currency. You don't need to signal political loyalty. You don't need to hide your moves in footnotes. You just need to answer 3 questions. Question 1. Do I want 0% in real money forever? The average person today has a portfolio that looks like this. 0% physical precious metals, 100% claims on someone else. Cash in a bank, stocks through a broker, bonds through a digital account, real estate with a mortgage and property tax obligations. Everything is a promise. Central banks are telling you, with their actions, we don't feel safe with 0% hard assets anymore. You don't need their level of paranoia, but you have to decide. Am I comfortable with 0% in things that exist outside the financial system? If yes, that's a choice. If no, that's the beginning of a plan. Question 2. How much outside the system do I actually need? This isn't about going all in. It's about taking a definable slice of your net worth, 5%, 10%, maybe more depending on your risk view, and saying, this part doesn't live in promises, this part lives in metal. For some people, that's mostly gold. For others, it's a blend of gold and silver. Gold for stability, silver for torque. The exact number is personal. What matters is, it's deliberate. It's written down. It doesn't change every time a candle on the chart looks scary. Central banks are moving from, say, 5% gold to 15-20% in some cases. You don't have to copy them, but you should understand why they're doing it and decide if you want 0% while they quietly march higher. Question 3. Do I want exposure or ownership? Central banks aren't buying. Gold exposure ETFs, leveraged gold notes, call options on mining stocks. They're buying bars, serial numbers, vault receipts, actual tons move from one cage to another. If your whole thesis is, I don't trust the system, and your entire position is a silver ETF in a brokerage account, a gold CFD at a retail trading platform, a sliver of a pooled account with no specific bar attached, then your behavior doesn't match your story. A normal person version of the central bank approach looks like this: gold, coins, or bars from major mints, silver coins and bars in practical sizes, stored in ways where a margin call is impossible. An app outage doesn't erase it. A rule change doesn't convert it to cash without your consent. You don't need a fortress. You need a plan that passes one simple test. If something in the financial system snaps tomorrow, do I know where my metal is and can I physically get to it? If the answer is yes, you have ownership. If the answer is, I hope my broker's app works, you have exposure. This is not about predicting tomorrow's price. Let's be brutally clear. Central banks just panicked. Does not mean gold and silver will go straight up every day from here. You should empty your bank account into bullion tomorrow morning. $100 silver is guaranteed. Markets don't move in straight lines. Even in historic bull runs, there are nasty corrections, long sideways stretches, shakeouts designed to flush out the over-leveraged and the overconfident. What central bank panic buying does mean is the people with the most information about the system's internals, who have no career incentive to be dramatic, are voting with billions of dollars against the idea that fiat and government bonds are safe, long-term stores of value. You don't have to agree with their vote, but ignoring it completely is a choice. Final thought: when the lifeboat crew puts on life jackets. Picture a ship. The captain and officers have told everyone for hours, relax, the ship is unsinkable. We've hit rough water before. We have the tools. Then you see something strange. The lifeboats quietly get unchained. The officers start putting on life jackets. They don't make an announcement. They just prepare. That's what record central bank gold buying is. They're not screaming. They're not running. They're not telling you to panic. They're just saying, with tons of metal, we've seen enough. We're not betting everything on paper anymore. You can. Keep dancing in the ballroom. Rush for the nearest exit and trample people. Or calmly walk to the deck, put on your own life jacket, and make sure you have a seat in a lifeboat if you ever need it. For individuals, that life jacket is a small, thought-through allocation to real money. Gold as the core. Silver as the leveraged cousin that moves harder when trust snaps. Not because you're certain the ship will sink, but because you don't want to be the only one at the party who didn't notice the crew quietly suiting up.